All right, let's dive straight in. Today, we're putting on our fundamental analyst hats to run an absolute masterclass evaluation of Concentra Group Holdings. If you love digging deep into the numbers and really testing companies against the frameworks of investing legends, well, you're exactly in the right place.
To cut right through the noise, we're going to run this stock through our strict 5-step framework. We'll look at the inputs, run the quantitative valuation models, apply the Warren Buffett and Peter Lynch checklists, and finally, deliver our investment verdict.
Okay, step 1, the input. We are analyzing Concentra, ticker symbol CON, using their freshly released Q1 2026 financial data. We're actually starting off with a really strong bull case here. I mean, the sheer consistency of their top-line growth is fantastic. Concentra is the nation's largest provider of occupational health services by location, and they just reported Q1 revenue of nearly $570 million. That's up almost 14% year over year. Plus, they're projecting a midpoint revenue of over $2.3 billion for the full year. It's just incredibly reliable, double-digit top-line growth in an environment where, let's face it, a lot of companies are really struggling.
Let's move right along to step 2, quantitative valuation models. Time to run the numbers.
So this table right here is our analytical workhorse, summarizing 5 distinct models. Let's walk through what we've got. First up, a price-to-earnings ratio of 18.24. That suggests the stock is pretty fairly valued relative to broader market averages. Second, when we factor in their nearly 30% recent earnings growth, we get a PEG ratio of 1.16, again, signaling it's fairly priced for the growth you're getting. But look at the price-to-book model. With a book value per share of just over $3, the PB ratio sits at a lofty 8.26, which definitely points to being overvalued. Fourth, checking out the free cash flow yield, or essentially a simplified reverse DCF. Management's guidance of $225 million in free cash flow against a $3.24 billion market cap gives us a yield of almost 7%. That is a super healthy cash return. Finally, if we look at analyst fair value estimates, driven by forward cash flows, the target sits at $29, hinting at a 20% upside. So, overall, it's a real mixed bag of fair to slightly undervalued signals on an absolute basis.
Now, this mixed bag is exactly why we need to look at relative valuation. When comparing enterprise value to EBITDA, Concentra's 10 to 12x multiple suddenly looks pretty expensive next to a giant like HCA Healthcare. HCA is this massive, highly diversified market leader, and it's trading at just a 9x multiple. So, while Concentra looks reasonably priced in a vacuum, you are absolutely paying a premium for this specific niche.
All right, step 3. Let's run Concentra through Warren Buffett's legendary investment checklist, really focusing on the moat and the management.
At first glance, you guys, Concentra completely crushes this test. Is it an understandable business? Absolutely. It's straightforward workers' comp and occupational health. Do they have a durable moat? Yes. Over 540 centers across 41 states. That kind of physical scale is incredibly hard to replicate. Are earnings predictable? You bet. Consistent net income growth across the board. Their return on equity recently hit a staggering 47.14%, completely blowing past Buffett's 15% benchmark. And management is definitely shareholder-oriented, actively paying a dividend and executing a $15 million share buyback in Q1 alone.
CEO Keith Newton totally hit the nail on the head in his Q1 remarks. This is the definition of a boring but brilliant moat. Employers implicitly trust Concentra because at the end of the day, keeping employees healthy and getting injured workers back on the job is a completely non-negotiable operational expense for businesses. It's just a super sticky, essential B2B service.
But here is the massive red flag that causes Concentra to totally fail Buffett's criteria: long-term debt. They are carrying $1.57 billion in total debt on that balance sheet. Now, Buffett likes to see debt that can be paid off in 3 to 4 years of net earnings. Concentra's projected net income for 2026 is roughly $198 million. If you do the math, it would take them nearly 8 years of throwing every single penny of profit at the debt just to clear it. That level of leverage completely destroys the margin of safety for a classic Buffett value play.
So, moving on to step 4, Peter Lynch's investment checklist. Let's see if this is his version of the perfect stock. As we step through Lynch's metrics, Concentra actually shines in a bunch of areas. We can confidently classify it as a stalwart, meaning it's a steady, reliable grower in a mature industry. For a stalwart, a PEG ratio of 1.16 is perfectly acceptable. The earnings growth is phenomenal, hitting nearly 30% year over year in Q1. Plus, it hits Lynch's perfect stock trades beautifully. I mean, it's a decidedly boring business doing unglamorous work. They're buying back their own stock, and any layperson on the street can understand exactly how they make their money.
But yet again, we hit a brick wall with the balance sheet. Lynch strongly preferred companies with low or zero debt, ideally a debt-to-equity ratio of 0.5 or less. Concentra's debt-to-equity ratio is a staggering 3.62. We're talking total liability sitting at $2.44 billion against total equity of just under $400 million. This completely fails Lynch's preference for a fortified, safe balance sheet.
If you look at the fine print from their Q1 release, management lists a cash balance of just $61.7 million against that giant mountain of debt, which gives us a net leverage ratio of 3.4x. Now, they note this perfectly complies with their credit covenants, and sure, their strong free cash flow of over $200 million a year means they can service this debt comfortably right now. But for a conservative investor using Lynch's framework, there's just no way. It's far too leveraged. Which brings us to Step 5, Summary and Final Verdict. Let's put the whole shebang together.
To sum up everything we found today, Concentra has an absolutely fantastic core business and really strong top-line momentum. But the valuation models are a mixed bag. It looks fair based on cash flow, but quite expensive compared to its peers. Ultimately, that staggering debt load forces a definitive fail on both Warren Buffett's and Peter Lynch's checklists. Because that leverage introduces such significant risk, our final verdict today has to be neutral. It's a stellar operating business anchored to a pretty dangerous balance sheet.
So, the final question you really have to ask yourself as an investor looking at Concentra is this. Does the undeniable operational excellence and strong free cash flow of this business outweigh the massive risks sitting on its balance sheet? Can management outgrow that leverage, or is that debt an anchor just waiting to drop? It is a fascinating setup, and I highly encourage you to dig into the Q1 financials yourself to see where you land on that question. Thanks so much for joining me for this explainer, and keep testing your assumptions.